Hi everyone, welcome to episode 6 of Fridays with FEMA. This is Ashish and I lead the tax and regulatory practice at Parakram.
Hi, I'm Janisha. I lead the corporate and regulatory practice at Parakram. So here we are, again continuing with our discussion on ODI. Today we're going to talk about ODI by an Indian entity. Now, first let's take a step back and let's understand what's an Indian entity, right? Indian entity eligible to undertake an ODI includes a company incorporated under Companies Act, an LLP or a limited liability partnership, or even a partnership firm. Any of these entities can undertake an ODI, right? So Ashish, to start off with, right, let's talk about sources of funds. So of course you can use cash consideration through banking channels to invest in the share capital of an offshore entity. Other than that, it's interesting to note that even swap of shares is allowed. So you can undertake ODI and acquire the shares of an offshore company, and in consideration of that, you can transfer shares of any other offshore company that you own, or even shares of an Indian company for that matter. More on the swap, on the shares of an Indian company for the shares of an offshore company in our subsequent episodes when we discuss FDI. But for now, just note that a swap is allowed in order to undertake an ODI. You can also acquire shares of an offshore company through a scheme of merger, demerger, etc. If the Indian entity has pending export receipts from the foreign entity, that can also be capitalized, and that's the other way to undertake an ODI. So these are some of the sources of funds or sources to undertake an ODI.
Sure. No, so I think you spoke about cash remittance, you spoke about some of the other methods through which we can do the ODI, right? Now, I think one important question that comes in is that today I've set up, I want to set up a foreign company and I have named my Indian entity as the one of the first shareholders subscribers to the memorandum of association.
Right.
Now, does that also count towards ODI, or only when I make the cash remittance does it amount to an ODI?
No, that would also count as ODI. So the ODI definition is very clear that even as a subscriber to the memorandum of the offshore entity, it's ODI. Please note that at the time of making an ODI, not the remittance, at the time of making an ODI, you're required to undertake filing requirements with your authorized dealer bank, and basis that filing, a UIN or a unique identification number will be generated for that offshore entity. And this form filing is called Form FC that you're required to file, right? So Ashish, to answer your question, the moment your name is in the memorandum of the offshore entity, it's considered as ODI, and hence it's at that point of time that you are required to make your filings by way of Form FC with with your AD bank, and get a UIN. That's the number one compliance required out there.
Sure. So in terms of Form FC, I think that means when we are making the when we are filing the Form FC and we are subscriber to the memorandum, at that point in time, we need to ensure that the Form FC has we take it out as non-financial commitment, right? Because there is no financial commitment that we are making at the time of subscribing to the memorandum of association. So that I think I would put as step 0. And then you do step 1 when you are actually making the remittance, and that is when it would become a financial commitment, and you are filing the Form FC the second time to send the money out when the company has been set up and the bank account of that company has been set up outside India.
Correct. So Ashish, so we will also file another Form FC at the time of making the remittance.
Correct. That's right.
And so when we are making the first Form FC, right, while we are subscribing to the memorandum of the foreign entity, we will also be required to submit a deferred consideration agreement to basically say that right now we are not remitting the money. We're going to remit the money in like 6 months whenever the bank account is up and running for the offshore entity.
Right.
And that's when you subsequently make the foreign investment, or sorry, so you subsequently make the remittance towards the foreign entity and again file your Form FC. So I think that's how it would proceed.
And what we have seen is that often people miss out on this understanding, where they think that only if cash is being remitted outside India do they need to file a Form FC.
Yeah, that's right. That's absolutely right. Okay, moving on from there, right? Ashish, let's talk about some of the key compliances that an Indian entity needs to consider. I think in terms of the limit, like when we were doing LRS, there is a maximum limit to remit outside India.
Correct.
So what is that limit for a foreign entity?
Sure. I think this limit has been there for quite some time. Uh, at an overall basis, what we should understand is that it is 400% of the net worth of the Indian entity, which means if your net worth is hypothetically 100, then you are allowed to remit up to 400 in terms of the investment that you want to make outside India. But there's a small nuance to that. This limit is known as the total financial commitment, and the total financial commitment includes both the equity investment as well as the debt investment, and it is for the total of all the investments you've made outside India.
So including your past investments, either
That's
by
correct.
way of equity or debt, everything should be, and your impending ODI,
Correct.
everything needs to be
Correct.
within the
So in
400.
my example, if I have already made investments of 350 out of the 400 previously, then in that situation, I am only allowed to make investments of 50 more in my new foreign investment.
Right.
Unless, of course, your net worth is going up, but that's a separate discussion altogether.
And how does one determine this net worth?
So net worth is defined as assets minus liabilities, but in the context of ODI, it is net worth on the last audited balance sheet of the Indian company.
Right.
So you will have to use that balance sheet, and basis that the calculation will have to be done by our accountant auditor.
So what's interesting is last available audited financials, not audited financials of the last financial year. That makes a difference, right? Because if I'm doing an investment in the month of July, my audited financials up to March may not be ready for the previous financial year. So I'm going to use the last audited available financials. Ashish, what would I do if I just set up a company and in 2 months I want to undertake an ODI?
Very interesting. I think we've seen this happen off and on, where an Indian company has been set up and the bank and it has been capitalized. Now the question is but there is no audit that has taken place, right?
Yeah.
So in these situations, you need to carry out the audit once the capitalization has taken place and use that audited balance sheet to calculate your net worth and then do your investment. One quick fun fact here is that every bank understands last available audited balance sheet slightly differently, and therefore there may be certain internal approvals that they may need to take. If you are using an interim audited balance sheet, which is basically in the middle of the year and not the last one. For a new company, it's of course that you have to do a interim audited balance sheet, right? Because there would not be anything available for the last financial year,
even if it's just 2 months.
Yeah, absolutely.
Got it. Okay, I think moving on from this topic, let's talk about compliance with pricing requirements under ODI, right? So, Ashish, what are the broad contours out there?
So I think on the pricing bit, I think there are a couple of things that we need to keep in mind. One is that under the new law, the pricing, the guidelines for the pricing, of course, while OI law talks about some of what has to be definitely adhered to, but the guideline now has to be developed. The policy with respect to pricing is now to be developed by each AD bank taking their own board's approval, which was not the case in the previous law, and therefore this gives AD bank a lot of discretion to be able to generate and draft their own policies.
Right.
The other point on valuation that OI law talks about is that the valuation should be on an arm's length basis. It should be done by an internationally accepted methodology, and it is preferred that the valuation workings are also provided for in the valuation report when we are doing the ODI.
Yeah, that's from a substance perspective to reflect that you have computed the pricing on an internationally accepted pricing methodology to give comfort to the AD bank.
And what we have seen is that the valuation report should also contain these expressions, right? That it is derived at an arm's length basis. The valuation methodology is an internationally accepted methodology. So all of these things are looked at by the banker before they approve the valuation to be used for ODI purposes. But I think one interesting question here, Janisha, is that if suppose I got a valuation report of $10, right? But I want to make the investment only at $1. Is that something that is going to be permitted? Is that something that's allowed? And what if I want to make it at $11?
Okay, so OI laws does not really say if you can invest above FMV, below FMV. it's all it says is your pricing has to be as on an arm's length basis at an internationally accepted pricing methodology, right? However, basis principles of FEMA, right? If we definitely can't send more money than required, so you cannot send $11 in your example if the valuation per share value is $10. That's definitely not happening. Um, so as a natural corollary, somebody might think that if I'm sending $2 for a $10 share, that should be okay because only $2 is going from India, right? As opposed to $10 which could have gone. However, even in that case, because the discount is so significant, the AD bank will look at it on a case by case basis. They will ask you questions as to why is there such a heavy discount, right? Typically, a discount of 20-25%, what we have seen is most AD banks are okay with. That's okay. So, $10 is the FMV you're remitting at $8. That's okay. That should be okay in most cases. But if you're remitting at $2, that discount is significant, and that's going to be evaluated on a case by case basis. So if I'm going to say, hey, I'm an employee and hence I'm, getting shares at a discounted price, that's a rationale that we are offering.
Substance over form.
Exactly. So it's going to be a matter of bona fide explanation to the AD bank, and only on that basis they would, in our experience, would be okay to allow that. Yeah.
Sure. I think it's very interesting and something that needs to be kept in mind, that the guidelines and the policy of the bank needs to be followed for making investments abroad.
I think, Ashish, with that, let's move to ODI in the financial services sector, right? So I think previous regime was limited in the ability of specifically entities not undertaking financial services to invest in financial services entities outside India. So just let's talk about what the new law talks about.
Sure. So just taking a step back on the pricing bit, Janisha, one quick point that I would like to make is that on pricing, the chartered accountant or the merchant banker, I think that becomes a pertinent question that comes up. Whose valuation report should be taken? Now, on that bit, while generally we have seen chartered accountants reports to be okay, the previous law, of course, said that if your valuation if the ODI you are making is more than $5 million, then in that situation you require a SEBI Cat 1 merchant banker report. The new law, of course, does not provide for any of that, but like I said, it's the discretion of the bank that is going to play a role here because of their policy. And we have seen a couple of banks take the view that if the investment is more than $5 million, then there is going to be a SEBI Cat 1 merchant banker report required. I thought I'd just quickly highlight that as well.
No, that's true. Yeah. Because we get a very common question that, do I need a registered value report? I think if it's below 5 million, most AD banks are okay to accept a chartered accountant's valuation report.
That's correct. Yeah. Moving to financial services very quickly, I think again this law has liberalized how we want to make investments in financial services. Now there are two concepts in my view that we should keep in mind. One is financial services. When an Indian entity is doing financial services and wants to invest into a financial services business, so it is financial services into financial services. And the other is Indian entity not doing financial services, but the foreign entity, but it still wants to invest into an entity which is doing financial services abroad, right? So financial, non-financial. Right. In financial, the regulations provide effectively three conditions. One is profit making. The Indian entity should be profit making for the last 3 years, profit track record. Second is that the Indian entity should be regulated or it should have a license from an Indian financial services regulator. And the third is the foreign entity which is going to be doing the financial services. The Indian entity has taken permission from the Indian regulator as well as the offshore regulator, if required, to be able to carry out offshore financial services business. Right. So that's the condition when you're doing financial. But if you're doing non-financial to financial, there's only one condition that needs to be met, and that is that the Indian company needs to have a 3-year profit track record.
So newly incorporated entity does not stand any chance of doing
That's correct.
ODI and financial services.
That's correct.
Fair enough. I think, Kashish, also the definition of financial services, right? OI laws talk about what's financial services vis-a-vis a foreign entity is. If that entity, if it undertook the same activities in India, it would require registration or regulation by any Indian financial regulator, right? So that is the test of whether the entity in which you are investing is financial services or not. Let's take an example. So a holding company structure in India, right, where more than 50% of the assets of that holding company are financial assets, and income also, more than 50% of the income of that holding company is also from its financial assets, then it would be deemed to be an NBFC, and it would require prior registration and approval from the RBI as an NBFC for undertaking its operations as a holding company. Now, similar holding company structures may or may not be regulated outside India, right? So you may have an holding company structure permissible in a particular jurisdiction, but because such an activity would be regulated in India, any ODI into such a holding company structure outside India would be considered as investment in financial services, and you would need to comply with whatever Ashish mentioned.
Correct. So basically, you cannot just set up a holding company outside India, because
you will have to evaluate
on
the financial service related compliances.
Sure.
I think with that, Ashish, let's quickly talk about what are some of the practical nuances or points to keep in mind when one's filing the Form FC, because a lot of times that takes a lot of time.
That's right. Now, on the Form FC bit, I think what we have seen with interacting with all these ED bankers is that each bank definitely has some of the other nuance in terms of filling up the Form FC. But a couple of things that we should keep in mind is, one is the NIC code. Now, the NIC codes are actually two codes that need to be put in. It's a 3-digit code of the 1987 list and the 5-digit code of the 2008 list. Now, we need to provide for the NIC code of the Indian entity as well as for the foreign entity. The NIC code should be synonymous to the objects of the company. Yeah, because that's the investment you are going to be making. So it needs to be clear that it is not on the it's not in a prohibited sector, and it is basically synonymous to the objects of the company into which you are making the investment. I think that's one. The second is, of course, you will require audited reports, like we mentioned, and your auditor needs to fill up one part of the Form FC. And the other important point that I'd like to make is that apart from the Form FC and the Form A2 that needs to be filled up by every single person, each bank has their own set of declarations and other letters that will need to be given to the by the Indian entity. So it is definitely important that we interact with the bank and tell them that we are making the investment outside India, and they provide you with that set of documents, which you can then fill up and send to them to be able to make this process more efficient and smooth.
Right. Understood. And I think one important point is that if a UIN has already been generated for that foreign entity, so let's say it was generated by AD Bank A, now you also need to ensure that you're routing the remittance.
That's right.
And your paperwork through that same bank A. Point is that once a UIN is generated, all the remittances have to be remitted, whether by you, by some other independent party who wants to invest in that company. It all has to be remitted through the same AD bank.
Correct. And here it also becomes relevant that everything is being actually remitted into one UIN, right? And therefore that UIN number is going to be required even by the subsequent investors of that foreign entity. And of course, the bank has to be the same. Of course, the branch can differ, but the bank has to be the same. And what is interesting to note here is that, and just a little fun fact here is that the regulation. So if Janisha invested through AD Bank A, and I don't have an account with AD Bank A, but I want to make the investment into the same UIN. Now, I will have to go and open the bank account with AD Bank A, which is perfectly fine. But the regulations provide that the bank account should be, the individual or the entity should be a customer of the bank for a period of 1 year. Now, it's interesting to say how this is going to play out. Of course, the bank has been given discretion to use that and then allowed for the investment to take place. But I think that's just some fun fact to note of.
More relevant for when an individual is investing, because applicable for individuals where you need to have banking relations for at least 1 year.
Correct.
So tomorrow, if I want to make ODI through bank X in which I have no account, I will have to hope that they will allow me to make it. Yeah.
Okay, wonderful. I think that's it for today. Hope to see you guys again next week. Thank you.
Thank you so much.